On Wall Street, the second half of December is usually known as the Santa Claus rally. Stock prices typically rise. Investors anticipate a surge of funds into the market for the new year. But record low oil prices and the Dow's 300-point plunge on Friday worries investors. Where is Santa this year? David Nelson, Chief Strategist of Belpointe Asset Management, is here with me. Is there a concern that this year, unlike typical years, is not going to be a Santa Claus rally?
It sure doesn't feel like that. At least so far in December, the markets are down already about 3%. And that's kind of concerning because this is the time of year, it's kind of a feel-good time of year where we just kind of drift a little bit higher. But there's been a lot of concerns weighing on the market, and some of the things that happened late Thursday night and even into Friday, were a lot of concern for investors.
Let's talk about some of the things that cause investors to bail on the market and cause that sell-off. One is oil prices. OPEC has decided it's going to keep producing oil, which floods the market with cheap gas.
It does. And you would think that there's the good side of that cheap gas is going to translate into strong retail sales. But the other side of that is we have a burgeoning oil market here in the United States. And a lot of those companies are really on the edge right now. Some of them are really suffering. They've issued a lot of debt, and they're going to have trouble paying that debt. And if they go under, that means lost jobs, and it kind of cascades around the economy. It's not good news always.
All right. Also, there's been a lot of concern, and this is not just in December, but all autumn we've been keeping a wary eye on China.
China has been a problem for the market literally the entire year. Almost every day we were getting negative data. Some good news is that over the weekend we actually got some decent numbers out of China. Industrial production was up, retail sales were up. I don't know if it's enough to keep the market going here in the United States, but we got some real concerns here.
There was also a giant red flag in the form of a junk bond fund, a mutual fund that told its investors, no, you can't take your money out. I didn't even know that was a possibility, David.
Yeah, that was pretty scary. And actually, the news came late Thursday after the close that Third Avenue was going to shut down one of their funds. The CEO has been fired. And they can do that. If they find that the markets are so illiquid that they can't sell the securities to raise the cash, they're not going to give the money back.
Why are these junk bonds a big warning sign?
It is a warning sign because we've had cheap credit in the United States ever since the financial crisis. The Fed has kept rates down to zero. A lot of companies have issued debt, in particular the oil market. About 16% of junk bonds out there right now are oil companies. It's quite conceivable that about half of those companies that issued those bonds could go under. That could spill around the markets. That's never a good sign.
And David, one of the most recent polls that we've seen on terror concerns asked people how likely is a terror attack in the next few months. 44% said very likely. What does that do to the jitters that people have about the way their money's invested?
The geopolitical concerns are always an issue. I mean, just over the weekend, we had Russia firing a warning shot on a Turkish vessel. It affects the psyche this way. When you have an event like Paris, an event like San Bernardino, you go to the mall, you think a little differently. Maybe you don't go to the mall. Maybe you buy online. Maybe you don't go to the movie that weekend. Those things add up. That investor concern starts to spread through the economy, and it's going to be a big part of the election, obviously.
The other thing investors are waiting for, and there's a lot of attention about, is whether the Fed is finally going to raise interest rates this week.
You know, ordinarily, given the circumstances that we have, they wouldn't be raising rates, but they've got to do it this time. If they don't raise rates now, they've kept them long for far too long, and it's had unintended consequences because some of that cheap debt has forced corporate America to really spend too much money and issue far too much debt to buy back stock and other things. I think this time they're going to do it. About 80% of economists think so.
Some of the things that you're mentioning here remind me of things that finance experts told me pre-2008 when we started to see the economy unravel. Are you seeing some of those similar signs percolating?
I don't think we have anything quite as bad as that, but it's definitely a concern, and a concern for portfolio managers like myself. Do we hit the tipping point?
All right.
And that's what I'm concerned about.
Well, Merry Christmas. David Nelson, thank you.